Hi, I'm Steve Miller, and this is a special for this week. We're going to share with you one of our most popular videos out of our members section, and that is FutureSpeak. We look at 25 different futures contracts and indexes, and we take a deep look on the daily and the weekly charts and use my unique type of cyclical analysis. I think you're going to find this valuable, and don't forget, go to askSlim.com and look in our members section to see all our offerings. Enjoy this free peek of FutureSpeak. FutureSpeak, November 18th, 2015. All right, here we go. Got about 45-50 minutes of work to do here, and hopefully we will cover something that is valuable to you. What we've had here is markets that have been, well, pretty much affected by what's going on in Paris and by weakness in commodity markets still. We've seen energy go from bad to kind of worse, and the dollar get stronger as there's been a flight to safety into the dollar, and also the prospects of higher interest rates moving money towards the dollar. We've had the metals, they have been weak, and actually had gold break down through an important key level. Treasury market trying to get a rally going, but man, they are weak also relative to the potential that they had for some pop on the upside. And pretty much stocks are choppy, giving up a lot of ground and then trying to get back up into resistance zone, which they have done as of today, yesterday also, though they've been bouncing around. Let's get right into this here as we start out looking in the energies and we look at the light crude market. So here we go with light crude charts as we always have it. The weekly is on the left and the daily is on the right for new viewers. And on the bottom are always my cycle brackets, which are the guides to the cycle rhythms for those of you that are new. So there is the weekly chart, and you can see here that what we have the projection in here looks for oil to continue on the weak side for some period of time yet. This yellow zone in here that would turn red if we get underneath this support right over here, and for the moment it's in this we'll call it market that's kind of easing to the downside in this corrective phase that it's in. It continues to look like that will be in place for well into next year, and now we have some breakdowns in the products in gasoline and heating oil, which I'll show you in a second, that are also speaking to further issues here for this market. So let's switch over to the daily chart, and you'll get a look at the shorter term pattern in here. And here you could see we were looking for it to tick up into minor resistance. It had this capitulation, as we'll call it, as it fell for 2 cycles without any sign of a visible rally. That is pretty rare. Now, you had almost the same thing here. You see that? And but there was actually a readable pop in there. You had nothing in here unless you call this little interday thing, so nobody could figure that out. Right now it looks like we had a 14-day low, though it's turning weak again, so we're not exactly sure if it isn't going to make one more low in here. It's possible, and then turn up. The pattern that I am suspicious of is a somewhere in here. Either this is the low or another day or two would be the low. We'd get a pop up, as you can see, into this resistance area and then pulling back on the downside again. So we're not 100% sure of that. This cycle in here, you see that's a little bigger one. That one is getting ready or is turning up. So that should give a period of rally in here coming up for a couple of these cycles. So let's say it looked kind of like this in here, and with the smaller cycles doing something like this within there. So that's kind of the pattern that we're looking for, and that would get you a rally up into the somewhere around 43.5, 44 sometime in the next couple of weeks. But it has to first settle in and make this bottom that we're looking for. And as you can see, that 14-day low might not have been it. Remember, we're running an average of between 7 and 9 days. So if it's 14, you figure it's 2 cycles, right? That would mean 16, 18 would be an acceptable amount of time. before it makes the bottom. And as we're looking at it weakening again in here, it looks like that short-term bottom is not quite in place, but we're going to look for it in the next couple of days, and then getting into that rally, which gets us up to, well, first resistance around, we'll call it 43.20, and then at around 44 after that. So that would be the target zone for the next bounce. But remember, it all lives in that weekly cycle that is pointing to the downside now, so that would mean that rallies will just continue to fail, and you can expect one pretty soon. So that is a look at the light crude market. We're going to switch over to the gasoline market, and gasoline and heating oil. These patterns now are not pretty at all. They went into a period where we were looking for a rally, and sure enough, that rally has come and not gotten very far. So you can see here in this cycle pattern that it got up to really the lowest point of resistance. That's really a bad pattern if it does that, and then gets another move below the low. So you see, this is the rally up here. It got just above that low to that resistance number, turned down, took out this last low, and that turns this channel to the downside. So you can see I showed you a long period of time in oil. This is a long period of time out to February, March in gasoline that just does not have a good pattern in it at all. When I switch over to the heating oil chart, you're going to see something very similar in here, and that would be calling for, well, there you go. It tried to get a rally. It made this really horrible left-hand translation. These two arrows, these two timing spikes point to these two cycles that nested over there and said that was a low. You got the rally, and now break the lows. That is a bad pattern. And so you see the smaller pattern in there. We revised that a little bit. It looks like the pattern that makes up 3 of those inside of each of these 1 is more consistent, and you can see this in here and this rally that failed already. Man, that is not good. And we're going to call heating oil and gasoline as patterns that are suggestive that there's still going to be a lot of weight in the energy market for a period of time. And all of these are lining up to oil through right around year end or so, and then gasoline and heating oil all the way out into like February. So not good patterns there at all. Natural gas was in a bad pattern, and I would say that we're going to call natural gas as improved slightly. Take a look in here. You'll see the big patterns in here, and you can see the beautiful cyclicality as you had these long moves and then beautiful advances and declines within these cycle patterns. I'm tracing out the big patterns on the bottom. You can see that right in here. Very, very nice patterns, all pretty much equal in time, and then getting into this rally period right over here. But what have we gotten in the rally period? Let's just look right here, and you could see that, well, that rally period got us the rally, right? So that was this rising phase in here, but then it broke down under this low. That turns this red and says there is trouble. And so now where are we? Well, we're in a period where a low is due within this really bad setup that we have in here. So this shows up in here that, the bottom is either in for this cycle right here within the big negative pattern. Remember, it got a rally up close to that resistance area and then has faltered a little bit, or possibly it has another couple of weeks in here where it may pull down and test that low. I think a price has been established at just under the $2 area for the low. If I look at the shorter patterns in here on the daily, remember I said there's like a couple of weeks left to go? Well, here's the pattern in here that looks the best to me. I put in an intermediate cycle right in there just so you could see there's kind of a half cycle also. So this is full cycle right in here. This is half cycle right in here. So you can see this one here, and this one here, and then this one here, and then this one here. So this goes out, let's say, another 2-3 weeks, just like it looks on the weekly, and that's suggestive of that low being made somewhere out in mid to late December, testing that recent bottom somewhere just close to the $2 area. This actually, the low on here on the rolled contract was around 219. So that's what we're going to look for, is a test of that area around 219 in a few weeks, and then making the important bottom. So that is a look at all the energies in what hasn't been a weak picture, and they have continued to be weak. We're going to jump now into foreign exchange. Of course, money moving into the dollar out of just about everything else, it appears, because the prospects of interest rates going up, and also the prospects of the European situation as far as terror goes being even worse than in the U.S. So, if that slows down their economy, and how about 50% supposedly of all travel reservations to Paris being canceled? That is a sad number, and that, of course, brings slowdown. Slowdown means stimulus. Stimulus means lower euro. Lower euro means higher dollar. So that's why we've seen more pop in the dollar. You're going to actually see how that shows up in the weekly and the daily charts in here. Here is the weekly chart, and we have been in this rising zone. Now you can see I have the cycles projected in here, which is what we have on all of our futures and our focus list of stock and ETF. So we have this pattern right in here. That's this right in here. And then after that, probably more rally. This high over here, which is the 2015 high, just around, let's say, just short of 101, may be where it's going for, still in this green rising zone, and likely to roll over in a few weeks and then get into this corrective phase, but right now still trucking on the upside. Now, I made a point last week that the daily pattern was really bullish. Why was it bullish? Well, it was because the length of time that it had rallied. In other words, this cycle right in here, that's this rally, took up all of the time and then started to roll over. So it was suggestive of the fact that it was going to get into this rally phase soon, and you can see the pattern almost perfectly. This was slightly revised because we gave it credit for a couple of more down days in here, but I mean the pattern is very clear, and now we're 4 days into the next rally phase, which is on the early side, and I think if you got a dip here in the dollar, you're likely to see it moving back to the upside again. Not quite ready for seeing the peak in the dollar the way this is looking. So we'll take a look here now. Compare this rising period in here to the inverse of that, which is the euro currency. We'll take /6E. Now I have this out to 10 years on everything to get all the cycles aligned up properly, and then I bring it in, and you can see, like we said, a few more weeks up on the dollar, right? Well, this is what it looks like in the euro currency, a few more weeks to the downside in here. You can see the half cycle right in here, and then this one here. So this has got a slight shift to the right side in here, and it might mean that the low comes a little bit sooner than what this suggests. We have to see how it aligns up, and then of course look at daily patterns. So right in here, this looks like a low around first or second week of December. So that puts it somewhere around 3 to 4 weeks out before the low comes, and that would help you see that it looks like 3 to 4 weeks before the high comes in the dollar. And here we'll take a look here on the shorter term pattern, and if we were to look for 3 to 4 more weeks, well, what we would look for in here is this pattern, which we've had drawn in here for a few weeks. We just tilted it more to the downside because of the magnitude of the decline. So we would make a low here in the next, call it a week or so, get a pop up, and then move down again, and that probably all takes several weeks to do so, and that probably is what makes the bottom in the euro. Some kind of a pattern like that, maybe it makes a basing cycle. If it got a good pop up to here at 108.70, that could give the potential for an inverted head and shoulders, but I'm looking way out there, and really right now what we're looking for is a few more days of weakness, and then a potential move back to the upside in a modest bounce, but still some time in the euro before we get any real sense that there is a bottom formed in there. So let's switch over now to the British pound. We'll look at that on the weekly here, and that one had turned negative, got a little bit of a bounce but overall still looking like it's going to move down here. This points to somewhere towards the end of the year before this period is over with. So British pound looking like it's got a little longer period of time than the euro does on the downside. We'll call that about 6 weeks or so of potential weakness here in the British pound. Now, just to extend this analysis out a little bit, you can see in here that it got the rally off of this low. You see that? And it broke underneath this level. That gives it all this time to fall. This is how the cycle then shapes up instead of the idealized pattern, which is right in here. And so that's what's called a left-hand translation, because this high is left side of this peak over here. That gives you a negative set up in here, and it says that you're likely to decline for a period of time. The only way to fix that would be a rally above 155.23, which at this point, based on everything we're seeing here, is a strong unlikelihood, and more likely that we're going to see more downside here in the British pound. Let's take a look here at the weekly chart in the Japanese yen /6J, and of course FXY is the ETF in there, and you can see the pattern that we have in here. Now, Abenomics, the news about that is that it's clearly not working. They're in recession. They got to give up in here at some point with this garbage that they've been doing for 2 decades and just say, let the market work. Well, look at this pattern right here. You see this right here? That's this right in here. So this is a better pattern, as it hasn't come down and made this low. And getting into this phase over here, the best trade in currencies coming up may be long Japanese yen. We're going to look for that potential setup as it's in the final weeks here of decline. Now remember, when you get into these late phases here on the weekly charts, you could get still a strong hit for a couple of weeks. So we're going to watch that and see whether or not in this final phase, which is the riskiest phase, we're going to get a rally. So here's the way this sets up on the daily in the Japanese yen, and you can see the patterns as they shaped up in here. So here's the cycle brackets as guides. This is the way these cycles shaped up. This one actually was a little bit short, right? And then this one came and it was a little bit long to make it up right on the money right there. And then you got this rally. How about this? Touches the 13-day on the slim ribbon, which went to negative momentum right over here and has about, well, let's call that a week and a half in this corrective or declining period before you get into this rally. Remember, we saw on the weekly that it was about to make a bottom. So we're going to let this kind of continue on the downside for about the next week and a half, and then look and see about this bottom, which will coincide with the nested bottom on the weekly, and then potentially give you a much, much bigger rally in there in the yen. So we're going to look for the yen to potentially give us a good upside rally in here. So based on cycle theory, the probability is better than 2 to 1 that it exceeds this high as long as this is the cycle formation like this. See that? And so we'll be looking for a rally to get to that level or higher, which is pretty a lot higher. On here it's 85.90 right there, and really a strong, would be a very, very strong move in here in the Japanese yen. So that would be our upside projection, and that would come in sometime in a couple of months right after this low is made and you get into this rally phase. So Japanese yen to me setting up as one of the best trades out there pretty soon. Then if you look at the Aussie dollar, you can see and hear the pattern that's shaping up. So right now our projection is that, you know, it might rally again. We're leaving a little room for a test up here, but then kind of coming down over here. Remember, we have natural resources still extremely weak, and this is related to natural resources. So you have that kind of a pattern in there, which is, well, not exactly a beautiful one, but it's still above those lows, so it's okay. We're still going to look for some pop in there, and we're also going to look for some pop in gold and silver and oil for brief periods, and that might give a lift to these, but I'm not overwhelmingly excited about that or the Canadian loonie, Canadian dollar, which has this almost same pattern. You see that still hasn't broken the low, still room to rally in here, but overall not really a fantastic pattern when you look at that in the currency. So what are we looking at? Dollar still strong for a few weeks. The euro currency still looking like it's going to pull back for a few more weeks. British pound even a longer time on the downside in there. Japanese yen probably setting up for a big upside trade just in the matter of the next couple weeks. So to me, Japanese yen is the trade to look for going out there pretty soon. Let's switch over now to the metals. /GC is what we're going to look at in here. Get this set up for you. And gold broke a very, very important bottom in the last week. It's entered into what could be a pretty tough phase for it in here, while the decline we were looking for that we've talked about for months lined up into late December to beginning of January. That has not changed. It's followed the pattern terrifically, and while some people were looking for much higher prices in gold, our thought was that wouldn't be till next year. Some people that were actually looking for a downside capitulation in gold. I wasn't sure that was going to happen, though I knew there was a weak phase coming. Now it seems like we're in there. So we're going to look at the potentials for where the supports are right now. Here is the weekly chart in gold, and I have up here one big weekly pattern for you to look at. That's this one right in here that you could see as it rolled over and brought us into this declining phase, aligned up with this declining phase that nests right there towards the middle to end of December. So that gives you this red zone in here because it broke underneath that low and looking like it still has, well, time to fall, and it's been falling hard. So let's look at where the supports are. I'm going to slide this like this so you can see the areas potentially of support. So that green zone on the bottom is the big monthly support zone. We have that there because we want to know, in case it goes into a capitulation, where the supports would be. This is around 945 down over here. Now there's a couple of downward channels right here. This close one, which has the support right there at, let's call it around 1035, and this bigger one in here, which has some support at just around 1013, let's call it 1010, 1013. So those are areas that I think are more realistic to look for this decline to go down to, maybe chop around in here, but still quite a number of weeks. Let's take a look at the daily chart and see how that lines up, because we might be able to get some kind of a projection based on these cycle patterns. So look at the clarity in here, the market geometry in the advances and declines in these cycles and how clear they are. As you can see, the advance and decline. So this decline that we're pointing at right here aligned with the weekly one that we were looking at, and that really had us believing that there was a lot of risk in here. Now let's take a much closer look, and we talked about trouble in late November and December right here. This is why you've got this big cycle, of course, coming off the weekly, coming down into towards the end of the year. You've got this one in here, which is, you can see the alignment of these right here, this horrible little rally, and then coming down. So that's still coming down to this time frame. And then the smaller one in there that is also very clear, and it divides up each of these in kind of halves. You can see that right in here as I follow these cycles right like this for you to see. And amazing, that comes down right here to the low today of 1062, looking like, see this, trying to form a hammer there, and probably going to get us this bounce. You can see that the next bounce, were to come up to this 1093-ish resistance right here, which is exactly the 13-day moving average, how that would set up beautifully for this big bearish trade right in here. Man, you could get somewhere, if you got that rally, you could get $80 to $100 on the downside as a trade. So we're looking for that to come and shape up the next area of resistance right here at about 1093. I hope it could get up there and set up the trade. We'll have to see how it trades. We're in this period right now of this smallest cycle, suggesting a counter trend move against this one and against this one. With all of this huge pressure in here on the downside, question is, how much rally can it get? Can it get up there to the 1093, or is it going to end up finding resistance? I'm even getting a closer look at here at some resistance number that's between here and here right there, which lines up to, let's say, 1078 to 1083. So those are the real short-term numbers in there, and 1073, 1083, 1093. So let's just have those in our mind. 1078, sorry, 1083, 1093, and somewhere in there a bounce, and then moving again to the downside and setting up that big bearish trade. So bad looking chart in there, and getting into capitulation time period for the gold market over these next several weeks. Let's switch this over to SI, silver, and you're going to see almost an identical pattern in here, as of course they do track each other. I did a piece, if you haven't seen it yet, in the Tools for Text on Tuesday that looks at the correlation between silver and gold. I think you'll find it very interesting in the tools to use to track the gold and silver ratio. So here we have that same 1, 2, 3 cycle setup. You can see 1, 2, and 3, and turning down. Same time period here towards the end of the year in silver, and in this big area of support again. And silver, the last couple of days, well, today it's worse than gold, but the last couple of days it's been showing some relative strength in there. And I actually think silver is going to outperform gold in here. And if you go look at and let's call that for the next couple of weeks as a swing trade, if you watch that segment in Tools for Text, you'll see why. So there is the weekly chart. It looks very much like the gold chart. Here is the daily chart in silver, and a similar setup to what we were looking for in gold, and that is a potential for a rally somewhere in here, but then giving it up for one more move to the downside. This cycle here points to a low date. We're just going to hover over it, and it tells us around 12:15. This cycle, the small one, says 12:17. So you could see that there's an alignment in there, and that's kind of the time period that we're looking for gold to potentially, gold and silver, to put in its bottom, or at least start the bottoming in there. So silver moving to the downside. This is that big support number, that green zone, where it came down and tested today, and still not able to make the bottom in here, just as gold also not able to make the bottom. Bad patterns in there. Take a look at platinum /PL, and here is that weekly chart. We'll bring this in from 10 years, and you can see also moving to the downside. It looks like the first low is a better place for the low than the second low. That puts the bottoming here towards around the end of January, sorry, beginning of February. So still in a very weak pattern in there. Copper, we're looking for a bottoming in copper, and this looks like it still has several weeks to go in here before that bottom comes. Remember when it was putting on this rally here up to 250-ish, we expected it to roll over because, well, we had this other part of this cycle coming up which said that rallies were going to fail, and this was the area for big decline. That was perfect, and now we have a resistance zone up around 223 where it starts as a short-term resistance in copper. Let's take a look here at the daily chart in copper, and you will see here what is a really weak pattern. This is a left-hand translation right here. So in other words, this nested low brought you only that rally, and then this decline brought you right to here. So we're going to look for a rally and then a decline to set up the low that we're looking, And then over here is the period where you can have a stronger upside move. That comes in around, we'll call it middle of December also. So you could see the alignment in here as they're setting up copper with silver and gold, all sometime around that mid-December period to late December period, as where an important bottoming comes. In the meantime, it's a high risk time. When you get all these final periods of decline, there can be a throwaway of some significance, and you can get significantly lower prices. Copper looks like it's in it right now, as world slowdown is apparently in the focus, as there are, besides issues with growth and issues that are gross, as far as our terror issues out there, the economies apparently will be slowing, and that surprisingly has not really influenced bonds very big on the upside in here, as we've seen these markets. Well, also we've gotten a bounce in the stock market, so maybe that's one of the reasons that the bond market hasn't gotten any legs on the upside yet. We're going to switch over now to the bond market, /ZN. Now, the cyclical patterns in here really speak to why we're not getting any kind of real buying coming into the bond market yet. Now, I'll show you that now as we start with the 10-year, which is very suggestive of the fact that there's another decline coming in bonds. So the thing that I'm looking at in here now, I want you to notice this actually is a 14-bar low right over here. I don't have the counts in there. This is also about a 13 or 14. This is 14 right here. And right now, this low that we made was only 9 out of 13. So what that means is that this is an incomplete cycle that's coming right down over here, and that this bounce right over here is a fake. Now we looked at the potential for, there's that 14 count right there, I couldn't see it. We looked for a potential for a bounce to come in the bond market that we thought would be a sale. In fact, on the 30-year I put up a shorting zone, and I'll show you that in a moment. Let's take a look here at the daily chart in ZN and see how this negative period is shaping up. So like I said, there's still about 4 or 5 weeks to go of decline. So this is the resistance zone. You can see it came up and touched it perfectly there and started to pull to the downside. This looks to me like several days of potential decline. If the stock market rolls over, especially on today's Fed minutes, then this might get a pop back in here, pull back down like this, then another little rally in here, and this is where a lot of risk comes in out here. We're still a couple of weeks away from what might be a period of a lot of downside in the bond market, but with a lot of zigzag potential right now. But I don't see it. I don't see 10 years getting above this 126.30 to 127.12 zone that's in here, and you can see the 89-day moving average. 89-day moving average coming across. So I'm just looking for some choppy action in here in the bond market, and then moving seriously to the downside one more time. Take a look here at the 30-year. We're going to switch this from ZN to ZB, and you will see that we had a sell zone in there, and you can see the last few days it's tried to get up into it and hasn't been able to. So here's that same pattern that we're looking at in here. Maybe chop around a little more, get a sell-off here, some more little rally, and then some more little sell-off as we go to that period that's about 4 to 5 weeks from now, before the ultimate low is in. Somewhere in this period, there's likely to be a hard sell-off, and not likely that we're going to see 30 years get above this zone 154.11 to, let's call it, at that 89-day moving average 155.17. So this is the whole sell zone in there, and we're going to look for a lot of chop with the most risk that we can potentially see to the downside. And I think if we get a break in the stock market and the bonds get a pop up into that sell zone, I think that will be setting up a potential short side trade. All right, let's take a look at this stock market. It has managed to move up into the upside retracement zones. However, the decline that we had in the last week and a half or so has been significant, and I'm going to show you that why it's significant. We're going to start out in the weekly pattern in the S&P 500 because I want to compare this to December of this past year because there are some similarities in there. Let's take a look here at this weekly pattern. Now, the similarity that I want to point to is right in here. So we had this big rally, 6 weeks, 248 points. It then had a big down week and then started to bounce back up. Here is 5 weeks, 238 points, a big down week, and then starting to bounce back up. Here, it did not quite get to the intermediate support zone, and I don't have the intermediate support zone in here, but this is well above it right there. Now, notice that this rally got back up over those highs. That would put it up here, back into this old high territory if it followed that pattern. There is a difference, though, in this market, and that is this was in a rising market, a big rising trend in here. This gave you a rounded top and rolled over, and now I contend we're still in this declining phase that's in here, and this big decline in here really pulls us down and tells the story. So that being the case, I have doubts about this being able to do what it did back in last December. But even then, when it did that, it just tickled out these highs and then went into another serious decline in here that was well over 100 points in the S&Ps. So this rally that we're in right there is, as soon as it peaks, we're going to roll over and get another hard hit into this cycle low phasing right there. Question is, where is it going to peak, and am I right about the big trend turning over? If I am, then it will not peak as high or make a new high like it did last December. So now let's take a look at the daily chart, and we'll see in here, let's get closer in even, these big patterns that it's following this rally pattern right in here, that if this rally was still pushing up strong, then this would not have been 17 days. It would have been shorter, and it would not have challenged this low right over here. So the fact that it gave up 90-something% of the rally off of this bottom right in here is not a good pattern. Now, the fact that it's gotten up into the resistance area, and look at where it touched. 2068 was the middle part of this minor resistance right there, and got up to it almost yesterday and then today. And that is what would be expected. Even the potential of getting up to 2080 right there. So my numbers were 2068, 2080 on the upside. And so we've gotten up to the first one in here. The question is, will it continue up? Will it roll over here and then give you this decline? Or will it continue up through the high to that resistance and then give you the decline here, which is the scenario from last December? I think this scenario right over here is the more reasonable one because of the turnover in the big pattern, that the big pattern turned over, and that sometime in the next few days it's going to find the resistance in this zone and then start to roll over. If that is correct, and it gets under this level right over here, which is 2020 on the S&P 500, that will be a nightmarish scenario. If we get above this level right over here, get a closing number above there, that will be a much better scenario. So we're going to evaluate it as it comes. This rally in here that we're getting was pretty much expected. And we'll just have to get a feel for, what happens, after the Fed minutes, how the markets and the world digests a slowing economy everywhere, the issue with terror everywhere, and how we're going to get past this phase of just huge political commentary all over the place that tends to be quite negative. So this is a very, very important area in here, and we're going to learn a lot. Remember in here, when they were falling right in here, I put in these words, and the coming rally tells a story. That's where we are right now with the coming rally telling a story. Let's switch over now to the NASDAQ. That pattern is going to look very similar to where what we have done here in the S&P 500. That is the weekly chart right in here, and you can see if we look back at that December period, you had that big rally right here, you had that sell-off right in here, and then it didn't make it to a high, and then had the second sell-off where the S&P 500 made the high. So I thought I'd show you what a divergence looks like right over there. Now, right now, the S&P 500 and the NASDAQ look very similar, and you could see this rally, this comeback right over here. If we switch over to the daily chart, and by the way, that was the 12-bar low, and the next low is due over here in sometime early January. So when it rolls over, we would expect it to roll over into early January from whatever point it rolls over. Take a look over here, and you will see the same thing I just showed you in the S&P 500. It gets down to the Fibonacci confluence level right over here and finds support, and then gets a bounce and just to the bottom of resistance right over here. Remember that the S&P 500 is now at the top, in the middle part of resistance. So this shows you a little bit weaker pattern in here in the NASDAQ than we have in the S&P 500. And that is, again, with the potential for it to do either fail from here and take out this low, which would be very negative, get above this level here, which is the 46.85, and close above there, which would then suggest a higher high. But giving up as much ground as it did, about 90% from this low, which touched that moving average, to this low, which touched that, I would say 85%, touched the confluence, is not a good picture. The odds of getting to a new high are greatly reduced when you give up that much ground. So again, we're going to be looking at this important area, and then once it rolls over, whether it be from up here or whether it be from right over here, this decline over here is likely to be somewhat significant. So we're going to really look closely at how it acts around these resistance areas. The Russell, RUT, is a much worse pattern on the longer term. Let's look at the weekly first, and you'll see that right in here. This Russell also not able to put on a whole lot of rally. This big red zone on these big patterns is suggestive of another big decline coming on the weekly. And when we look at the daily chart in here, you will see the same thing, as it has now moved up to this bottom, not quite the bottom of the minor resistance. You can see that the Russell is also weaker than the S&P. The resistance area and that 89-day moving average moving down to around 1170. If it got back under this area of 1140, it would be very negative. A close above 1177 would be suggestive of testing that high over there before it rolls over again. My belief is that it is going to take the more negative track, as my belief is in all of these stock indexes. So that's a look at the stock market. Very key area. Like I said, this rally is going to tell us the story of the condition of the market, and the sell-off that it just had really is part of that story, in that it gave up so much ground. I didn't even show you on the Russell. It gave up 100%, actually getting exactly to the same support area. So all of that telling, kind of the story that is more negative. And we're going to be looking for a failure in these resistance areas right now, and unless the market proves differently, and I actually don't think that's going to happen. So that is a look at the stock market. We'll take a look now at the grain markets. Basically, we're looking for rallies to fail in these grain markets, as they have taken on a weaker setup, and we'll show you that right now in all of these grains. And then we'll look at coffee, which has actually taken on a much weaker setup. Here is the chart. That's still the Russell, right? We're going to move this over to /ZC for corn. and there you go. So there's the corn pattern. It's almost testing those bottom, or it did just barely take out that bottom. That confirms this downturn that we had in here. The decline in here is suggestive to the end of January /ZW. This a very similar pattern. The decline in here suggestive to the end of December, right over there, and so not quite taking out the low, and you can see that wheat looks a little bit stronger than the corn market does, but maybe not by much. Soybeans /ZS, this is looking like it's got a negative period out into the middle of January. That's this red zone that's right in here, and as that has taken on much more of a negative character, and you can see the cycle alignments in here as the phasing tells you rising phase, corrective phase, or bearish phase. And this bearish phase that we're in, I mean, that's a long period of time. So soybeans also looking negative. /KC is the coffee market. Look at the breakdown in there. Man, I was hoping for that to be able to withstand it and move back to the upside. That now turns this channel to the downside. So what we have in here is 3 cycles that made up this last pattern right in here. Pretty similar. You see this crummy rally in this bigger pattern, and then it took all this time to get to this low, made up of 1, 2, and 3 patterns right in here. Well, here's the same rally in here. Crummy rolls over, takes out the low, a tiny little low do here in a couple of weeks, an attempted rally, and then 3 of these cycles that goes out way into next year. This cycle pattern here is suggestive of the ultimate low in coffee being way out in April of next year. So bad pattern in there, and if these cycles hold up as they look, the ag market softs, I mean, they just don't look good for a while. So we've got all this slowdown out in the world and all this talk, and I think that what we're seeing is a good reason to believe that we're going to continue to see soft commodity markets for a while. You know, my look at the potential for gold and silver to have a good time sometime later out into next year, that could take some time to develop based on what we're seeing, and maybe that the real upside move doesn't come till second quarter next year. In gold and silver, just some modest basing and upside move earlier in there in the earlier part of the year. But overall, basically the commodities in general are just in, you know, very, very soft patterns without any real sign that there's any bottom coming. So that's what we're looking at in here. And without all that pricing power, with the real soft commodities and the softness in the world, can the stock market actually withstand that? I doubt it. That is FutureSpeak for today. I hope you found it valuable, and I certainly hope that you find a way to profit on some of the analysis I offered. And my biggest wish is that the way I look at things, the type of analysis I do, grows your own knowledge base, and then you can take my teachings and expand on it and even grow it on your own. That's FutureSpeak for the day, and I will see you in the next segment.
Well, I'm going to the city and I'm gonna do a stage.